Welcome to Market Catalyst. I'm Julie Hyman, 30 minutes into the U.S. trading day, and we have pretty little changed market today. We're seeing a mixed picture right now. The Dow is off by about 190 points, the S&P little changed, and the NASDAQ is also very little changed here. So we'll get into earnings in more earnest later in the week. Palantir, for example, reports after the close today. So that will presumably be a little more decisive for markets in some cases. We got the jobs report at the end of the week as well. And then there's what's going on in the oil market. Oil prices are higher after President Trump said the U.S. is going to guide stranded ships out of the Strait of Hormuz. Yahoo Finance's Jake Conley is here with me now. So Jake, what is going on? I guess, I'm just trying to wrap my head around this. There's all these ships that have been stranded. They've been trying to get through the strait. They can't go through the strait. And so now the U.S. is effectively going to ferry them through. Is this the idea?
So you're asking the exact same question that every vessel owner of those 400 or so ships is trying to work out right now. Now, what President Trump initially said was that the U.S. would guide these ships through. The Wall Street Journal, however, has reported that that will not include naval escorts. There will not be naval warships from the U.S. escorting these vessels out of the strait. Instead, there is a proposed path that goes along the southwestern edge of the Strait of Hormuz through Omani waters. And CENTCOM here in the U.S. has said that it will provide missile destroyers and other technology to assist in those vessels, but there will not be direct escorts. I've been on the phone this morning with some people in risk and insurance in the maritime space, and they are telling me that without really firm security guarantees, without escorts, without absolute assurances of safety, a lot of vessel owners are still going to be really, really loath to try to make this bet and see if that actually works and see if they can get across, because the risk is still just too great, especially after we saw Iranian leadership saying that any U.S. interference, like what President Trump is suggesting, would be read as a violation of the ceasefire and would be met with action accordingly.
Okay, so I guess now what is then the next part of the question, Jake? Because if a lot of ships aren't taking us up on our offer, then we remain where we were.
We remain exactly where we were. The U.S. has said it won't remove its blockade of the Strait of Hormuz until the Iranian regime signs a deal. Iran has said it can't negotiate until the blockade is removed. So we've kind of been in this stalemate for a while now. In terms of what next, you saw President Trump in his statement over the weekend saying that there are positive discussions happening between the U.S. and Iran. You saw this morning the Pakistani foreign minister saying that Iranian crew were evacuated off of an Iranian ship in a partnership with the U.S. and with Iran, suggesting that there may be some kind of back channel open. Now, how effective those talks are when we see public negotiations resume, it's impossible to tell right now. But until we get some more clarity, everyone I'm talking to keeps telling me we're kind of stuck in this quagmire of nobody wants to be the first mover, especially if you're a vessel owner. And the problem is that the global oil market continues to lose 10 million plus barrels per day of oil every single day this goes on.
Well, and by extension, gasoline prices here in the U.S.
By extension, gasoline prices now at $4.50, $4.43, somewhere around there. A year ago, those prices were at $3. Only 2 weeks ago or so, they were 40, 50 cents lower. So you've seen how fast this is jumping up. We often talk to Patrick DeHaan, who runs the Gas Buddy X account. He's saying that his models can't even keep up with how fast these prices are moving. That's a pretty serious statement. And Americans are going to be looking at that number. It's one of the only numbers that I think you can ask somebody who drives regularly, and they probably know where it is within 10 cents. President Trump is going to be watching that ahead of the midterms. And those prices are going to keep going up the longer the market keeps losing all of this crude oil.
Yeah, 435, New Jersey. Luckily, I did not have to fill up the tank this weekend. But
luckily.
Obviously, we're just putting off the inevitable. It's got to happen at some point. And we'll probably be higher by then.
It'll
Jake,
probably be higher.
Thanks a lot.
Thanks, Julie.
It. Well, optimism around earnings seems to be powering the markets to new highs, even as investors are shrugging off mostly those geopolitical concerns we were just talking about with Jake. Joining me now is Gargi Chaudhuri, BlackRock Chief Investment and Portfolio Strategist for the Americas. Thanks so much for being here.
It's great to be here, Julie. Thank you.
So I want to start with what we were just talking about with our Jake Conley. That is gasoline prices not coming down, going in the opposite direction, and the market's continuing to be unconcerned, seemingly, about this situation. What would cause that to change?
So absolutely, it has been a little bit of a divergence between equities and what we're hearing from the ground in terms of ships in the Strait of Hormuz. I think there are a couple of things to focus on here. The first one is just the economy as such and the much better than expected numbers that we're getting across several different components. So if you look at sort of the ISM and the PMI data, if you look at some of the initial jobless claim data, and obviously we're going to see the labor market. And then if you see core inflation, I think all of that is pointing to evidence that the economy is in a good place, or at least the starting point around 2% GDP, great. But then the second most important point is just that earnings season so far has been so solid, so much stronger, even from the beginning of April to now, so much stronger than what was expected. I think markets are absolutely trading on that micro news as opposed to the oil price.
I mean, understanding that business investment is making up a larger chunk of economic growth, consumer spending is still a very significant part of it. At some point, one would think, I mean, listen, we know what happens with consumer confidence, right? We look at the gasoline prices, we feel terrible, and then we keep going out and spending money.
Exactly.
But if that starts to not be the case, would that be the thing, even earnings notwithstanding? I get it, but I guess I'm still trying to understand at what point would it be a problem?
And look, I mean, if you look at earnings, just coming back to the point around business investment, I do want to say that profit margin, I think that was one thing that really led to this incredible April that we just had, which was that margins were actually expanding. And that was not something that any of us had written down in our forecast sheet for Q1. So the recognition that profitability, that it's not just all about AI CapEx, that companies, the larger companies are able to convincingly turn that into revenue has had a meaningful impact on sentiment. But I hear your question. Certainly, if oil prices don't just stay here, but continue to rise as we're seeing today, is that something that consumers are going to eventually care about? Yes. Is that going to impact all equities? No, that's going to impact certain components of the equity market, whereas others, such as those focused on large cap and AI in particular, probably continue to do well. So a K-shape in the equity market probably continues. And I think that's exactly what we saw in April, where it wasn't all equities that went up. It was really the larger cap, AI-related, and obviously energy sector as well that continued to do well.
Okay, so how are you thinking about that trade right now and where to sort of be invested?
Absolutely. So we were writing our spring investment directions through the middle of some of the volatility and headlines. And there were three things that we focused on. The first was just this idea of durable growers. So really the places in the market that, despite the headline news, will continue to show some profitability, some revenue growth. And that's obviously things like BAI, which is our active BlackRock AI tech fund. I think that's something that investors, if they don't have that in their portfolio, should continue to focus on. And really playing the value chain of AI.
Well, that's what I was going to ask. So you're still sort of looking at picks and shovels and less trying to pick who's going to get that ROI from AI down the road. You're more focused on the build-outs.
I think that for now, the build-out is still happening, and the build-out is happening not just in the sort of large cloud service providers, but it's also happening in memory and compute. And that's the big learning of April as well, that it's not just about the US, it's about emerging markets as well. So focusing on emerging markets, countries that are the largest producers of some of this compute that is very much needed, is something that investors should do. So focus on large cap, away from small cap, focus on AI, and actually rethink emerging markets and the role that they had. So those are your durable growers. At the same time, I'd say the big lesson of March 2026 was similar to 2022 in that diversification was not to be found in your traditional diversifiers. So recognize that you need newer types of diversifiers where bonds don't quite do the job for you in a stagflationary world. So reconsider tips. Reconsider what we call liquid alternatives, which is really long-short strategies, and some of those are in ETF tickers, such as IALT, which is our liquid alternative strategy, which again, in March, where everything else was not working, was one area of returns in your portfolio. So diversify the diversifiers, focus on durable growth, and then for downside, focus on income. There is a role for fixed income still, certainly in inflation-protected bonds, but I think also in multi-sector, shorter-dated income-producing bonds.
Okay, and now that we are through mostly earnings season, definitely big tech earnings season for the most part, what are you watching as the next catalyst? Is it going to be the jobs report on Friday, or are there other things that you're watching?
I mean, maybe I'll start off with where we started off this conversation. I think we have to, sometimes the market gets a little inundated with headline volatility, but I think we have to keep oil prices in mind. So I'm still watching that, and shocks there will absolutely have an impact on growth forecasts and inflation forecasts. I'd say labor market remains really important. So obviously this week's print, but frankly, the weekly jobless data is what I'm looking for as well to see how that translates. And then lastly, I'd say that, even though earnings season might be over, one of the things that we want to see is how are companies and consumers responding to a $4 or $5 gas price at the pump. And we'll see that in some of the consumer-related data, whether that be retail sales, but we'll also hear that from companies. So keeping all of that to sort of determine how the next part of, of this quarter goes.
Great. Gargi, good to see you. Thanks for coming in. Appreciate it. Coming up, we're going to go live to the Milken Institute Global Conference in Beverly Hills to talk about the state of private credit. That should be interesting. Apollo President Jim Zelter joins our Brian Sozzi next.
All right, welcome back to Yahoo Finance. I'm Executive Editor Brian Sozzi here at the Milken Institute Conference in Los Angeles, and we have a big day of lineup. You're coming here to our program, kicking it off with Apollo Global Management President Jim Zelter. Jim, good to see you in person for a change.
Always good to see you too as well. Thank you.
Look, I want to talk about all things private credit, but we come here at a time where the stock market is trading at a record high. Jim, I just passed a $6 gas sign in California. I'm not used to seeing that in New York. Does the market reflect reality?
Well, how I try to summarize it in use a little bit of a golf analogy. In the middle of fairway, you got a great CapEx cycle, a big M&A cycle, consumers in pretty good shape, M&A cycle, the whole bit, IG cycle strong. And in the rough, though, you've got the geopolitics, you got the conflict, and you got inflation. The problem is that fairway to rough used to be 90-10, and now it's around 65-35. So it's a pretty narrow fairway. So I do think no doubt, energy prices have spiked, but when you really pass that through and you add up to the economy, it's 10 to 15 basis points of GDP growth. So no doubt there are some macro concerns, but we were all really wrong after SVB, and we thought there would be a massive credit crunch, and that did not take place. So a little bit of the consensus, this CapEx cycle, to put in perspective, that's going to be $800 billion this year just from the Mag 7. So these are extraordinary numbers.
And so many investors, look, I'm a golfer, I play golf, they are living in the fairway. How long can that life in the fairway continue? At what point do we have to pay attention that the rough is 10 feet tall?
Well, I certainly think that's going to be, there's a lot of bigger questions. I know you want to talk about the small pond of direct lending and private credit. The ocean of investment grade private credit is so much bigger, which we'll get to. But I do think right now these big trends that I was talking about, an administration that's very pro-business friendly. You've got an M&A marketplace that's pretty, risk is on. Valuations are quite strong. Earnings have been quite strong. So, these are all confidence games. And for me to sit here and predict, I think I'd have a pretty poor record. I'm more of a practitioner than a predictor. But I certainly think that the wall of worry has been overcome in the last 4 or 5 weeks to a great degree.
Are valuations still attractive to you?
Well, you got to remember, we, for the most part, if you look at our platform right now, we really are, our biggest business is our credit business. Obviously, in our traditional PE business, we're being very thoughtful about where we put equity under a leveraged capital structure. So I wouldn't say valuations are extreme. They're certainly full, and they reflect a lot of optimism, no doubt about it.
We're just getting past, you mentioned AI and funding for CapEx. Every single hyperscaler that came out last week raised their CapEx guide. In some cases, those stocks were crushed. Who is going to fund all this AI infrastructure?
I think that actually is the most fundamental question today in the next 12 to 18 months. Let me put a couple numbers in perspective for you. This year, net origination volume in the IG marketplace, north of $1 trillion, that will exceed net issuance versus the U.S. Treasury market. That's an extraordinary statement. And if you think about that $800 billion, a portion of it will be funded by the cash flow of these companies. A few $100 billion will be funded by the public IG markets. And our stance, and very consistent, is private investment grade capital will be the third leg of that funding tool. So the public-private convergence in terms of scale, in terms of transparency, but it's going to take all the markets. It's going to take the equity market, operating cash flow, the public IG market, and the private IG market for those kind of numbers to come through. That's what it's going to take.
We saw the reaction to some of these capex increases. The market seems to be saying, you know what? All right, we appreciate what these companies are doing, but we are unsure on the returns. If the returns do not meet expectations for these capex, for these AI infrastructure projects, what happens to IG/investment grade credit?
There's probably not an issuance where you have impairment of debt, but certainly the equity returns of these companies that are the greatest of all time, the trajectory of equity returns will be a lot lower, and it will be a capex cycle that has been wonderful for the beneficiaries of the consumer and the end user. But your question on the real return of invested capital, that's a 27, 28, 29 issue. And in terms of commercial application, revenue, growth, and otherwise, we will yet to see that. But that will be the question. As we're sitting here out at Milken in 28 and 29, that'll be the topic of conversation.
What do you think people will be talking about then? Is it more scrutiny of this AI build-out?
Well, I think there's a number of issues. Obviously security, to make sure that it's in the right hands. Obviously a lot of great concerns about some of the scientific and creative experiments that have been done in the last 6 to 12 months in terms of things like mythos and things of that nature. But certainly I think the big question will be this overall economic return, and these are pristine balance sheets, and these companies have gone from buying back excess stock or stock in the last couple of years, 150, 160 billion a year, to doing 800 billion of capex. So they've got the marketplace on their side today. But once confidence erodes, that's a very tricky situation. So I'm sure we'll be asking ourselves that question in 2 years.
What's as some of these hyperscalers increase capex, what does it mean to the debt on the balance sheet of some of these software players? Because theoretically, as you see capex increase for these hyperscalers, they are disrupting a market. They are driving the next decade of AI and technology. Like, what does it mean to these software companies? The equity has been hammered.
Well, on the public markets, the equity has been hit dramatically. I think there's a whole class, and we've talked about this, 2019 to 2022, a lot of private equity capital went into these structures. And I know the concern today is about the debt of those companies and the question of, success, default, impairments. But certainly if you're worried about the debt, you have to understand what the implications are for the stock. And I think equity returns will certainly be in question. And the other item today is that it's probably easier to create something from scratch than to restructure and reduce something that's existing. So I think that's a story that will be over the next 24 months. We've been fortunate in our equity business. We've really avoided that software space. And even in our credit business, we have a smaller allocation. But there will certainly be winners and losers. And it's a little bit too early to tell. I don't buy the argument that you've seen nothing that would give you warning today. That's probably correct from a current revenue, but I think the trajectory of that growth has to be in question.
This has been quite the year for all things private credit. What do you think the market is still misunderstanding about in terms of private credit? And then secondarily, what happens to some of the new players that entered this industry? Do you see that shakeout actually happening?
I think the big story in private credit that really has yet to really be articulated and embraced and understood is the significant amount that really is in the investment grade world. We've been very vocal for the last several years. It's a 40 trillion market. The non-investment grade market is a 2 trillion private credit market. And so back to our first conversation about where this capex is going to be funded, private credit in the investment grade world is the big story of the future. And that's really where the convergence of public-private valuations, public-private transparency. That's where really it's all going to come to a head. So I think that'll be the conversation for the next 12 to 18 months. Certainly there's a conversation right now about the BDCs. It's an interesting one, but I don't think it's the topic of mainstream conversation, and I don't think it impacts market structure as much as the impact of IG marketplace and IG issuance.
Jim, thanks for kicking off our coverage. Good luck with earnings coming up. I appreciate it.
Great, thank you. Always a pleasure.
Julie, back to you.
Saz, thanks very much, and thanks to Zelter as well. Appreciate it, guys. Coming up, investing in U.S. manufacturing. I'll talk to the CEO of Siemens USA next on Market Catalysts. Siemens USA hitting $1 billion in U.S. manufacturing investments as new projects come online this year. That includes data center infrastructure manufacturing and manufacturing of electrical equipment. Joining me now is Ann Fairchild, Siemens USA CEO and President. Ann, thanks so much for joining me. I'm curious about this milestone that you guys reached. How much of the $1 billion was sort of in the planning? How much of it was pulled forward as a result of tariffs and you all thinking differently perhaps about your supply chain?
Yeah, thanks, Julie. It's so nice to be with you today, especially as we announce this $1 billion milestone. And it's a fair question, right? I mean, this $1 billion is the cumulative effect of investments over the last 5 years. And so definitely the pipeline and actually many factories coming online over the last 5 years as we've continued to bring up our investment. A lot of it is associated with our build out of the electrical infrastructure. I mean, Siemens is the leading technology company helping to serve America's industries, infrastructure, and transportation. And we like to build close to where our customers are located. The U.S. is our largest market. We have over 50,000 employees here in the United States and factories, manufacturing facilities from California and Texas to New York, Pennsylvania, and the Carolinas, really across the United States. So much of this has been in the planning for quite some time, but we're really excited today to announce that we've reached that $1 billion milestone.
Okay, so to go back then to the tariff question, how much of that has sort of fed into your thinking and planning about all of this?
Well, a lot of these investments, Julie, were planned long before we saw the tariff implementation over the last 2 years. But certainly for Siemens, like all companies doing business in the United States, it's a topic that we've had to carefully navigate over the last few years. Our local for local investment strategy that we've really enhanced, to be honest, over the last decade, really has helped us to bring on more resilience, to implement a supply chain that is more local to local, closer to our customers and the markets that we serve.
As we talked about, 2 of those 4 investments are tied to AI data center demand, providing electrical components to some of those facilities. We know, just hearing from the hyperscalers last week, that there are some bottlenecks in certain parts of that build out, right? They talked notably about things like memory chips. I know gas turbines are another area that are way backlogged. So I'm curious where you guys are seeing those bottlenecks and how much some of this U.S. capacity might help to alleviate them.
That's a great question, Julie. Thank you. I think as we're looking at the bottlenecks that we're seeing in the United States, I mean, workforce is one, and our investments are helping to provide additional jobs in the United States, about 2,200 jobs over the last 5 years, including through 2026 that we will make available in the United States. That's one issue. I think another major issue in the United States is the demands and the constraints on our energy supply. As we're looking at where our infrastructure build out is happening and needs to continue to happen in the United States, this is where we've really been able to deliver state-of-the-art electrification equipment to our customers to help address the increasing demands, not just from AI, but certainly the additional manufacturing and onshoring that we're seeing here in this country.
So I guess kind of related to that then, we heard some of those hyperscalers say, we're seeing more demand than we can keep up with, right? We don't have the capacity to supply as much compute demand. What are you seeing in terms of your demand supply equation at this point, particularly in that sort of AI related demand for your products?
This is a challenge that everyone's facing right now. There's huge demand. We're able to, at this point in time, fortunately, meet the demands of our customers. And the build out of the manufacturing portfolio that I mentioned, those investments we anticipate will continue. We see that we're able to really favorably invest in the United States to build out capacity, to train the workforce, to really elevate our ability to keep up with our customers' demands. Our customers do include the hyperscalers and some of the largest technology companies in the world, but also many of our small and medium enterprise companies that are also benefiting from the expansion in the United States.
You mentioned a couple of times the workforce, and I know you all are planning more hiring through 2028 to help staff these various manufacturing facilities. How hard is it to find people right now? Is it hard, especially when you're looking for people who are skilled tradespeople?
Thank you for that question. It's something that is near and dear to Siemens. I mean, we've invested in our own workforce, but we've also committed to train over 200,000 manufacturing and electricians by the year 2030. And we believe that it is upon us as employers, along with government, labor, and academia as part of a larger ecosystem, to help provide the training pathways to those careers. U.S. manufacturing has, I believe, over 400,000 jobs open right now that we're not able to fill. And when we talk to our customers, including the biggest technology companies that are out there, this is also a shared challenge. We really see that there are more jobs than there are trained individuals to fill those jobs. And AI certainly helps us. Industrial AI, where Siemens is a pioneer leading, will help us to address efficiencies on the product floors, but it's really the humans that will help us to bring those technologies online to help enable the full scale of what AI and industrial AI can bring. It is really for us to really help to develop, to provide more training opportunities for our workforce and the workforces of the communities where we live and where we operate.
And then, Anne, one thing in your in the manufacturing release stood out to me, and that was passenger rail. That you guys, one of these facilities is in Lexington, North Carolina. It's a passenger rail manufacturing hub, and I was just, I don't think a lot about the passenger rail business, I have to admit, in the United States. I don't think of it as a very rapidly growing business. And so I was just curious from you, is this like replacement Amtrak cars we're talking about? Is it subway cars? Like what kinds of things will you be making there?
It's passenger and locomotive coaches that we're building in the United States. I mean, we're very proud to have just opened our Lexington, North Carolina facility. It's an enormous facility. It'll bring about 500 jobs to the state of North Carolina and over 1.6 billion in potential revenues to the state over the next decade or so. But we are seeing an uptick in passenger rail. There's a keen interest in all forms of transportation. And Julie, I would urge you to take a train to explore the benefits and the ease and relaxation that you enjoy compared to other forms of travel when you're on a train. I won't speak to our particular customers and where they're investing, but we do see tremendous growth opportunity across the United States.
I will say I did recently take an Amtrak between New York and DC. It is one of my, I just don't have occasion to do it very often, but I do very much enjoy the experience, I will say that. And thank you so much for joining us. Really appreciate it.
Thanks for the opportunity. Have a great day.
You too. Coming up, what earnings are signaling about the state of the consumer? That is next on Market Catalysts. Consumers are still spending, but are increasingly selective and price sensitive. Yahoo Finance's Josh Lipton spoke to Deborah Weinswig, Coresight Research founder and CEO, about what we've learned from restaurant earnings.
Maybe you start bigger picture, Deborah, because we've heard from a lot of restaurants and food companies. You've looked through those earnings reports, Deborah. I'm sure you've been listening to the conference calls. What is your big takeaway from that on the state of the consumer, Deborah? Like how healthy, how resilient does that consumer look to you?
First, thanks for having me. Secondly, I would say that at, kind of where we are in the earnings cycle right now, and from talking not only to QSR across the restaurant spectrum, we also spend a lot of time in real estate so we can get a better sense of what they're seeing. I would say that this idea of like an exaggerated K, we've always called it the hourglass, but you're really starting to see those customers who are more price sensitive are even more price sensitive. And those who are in the kind of upper part of the hourglass are continuing to feel better, right, with the market. And price is not the driving factor. It's the experience. It's, kind of additional awards or rewards, but it's kind of the more than.
Let me ask you, Deborah, front and center right now for a lot of Americans, and certainly in the conversation, are these elevated gas prices. I'm just curious, if those gas prices, Deborah, let's say the national average kept moving up, goes to $4.75 or $5 even, are there certain kinds of restaurants and certain kinds of restaurant categories you think would be more at risk?
Gas prices are, of course, on top of everyone's minds, except those of us who are in places where you don't drive as much. And what we're seeing, and this is in grocery and restaurant, is that last mile piece right now is continuing to change the game. So those consumers who are willing to spend on a last mile delivery company to bring your, kind of product to you, that is absolutely winning in this environment. And many companies have still not set up a gas surcharge, which I also find, some of these drivers, right, they're really hurting as a result of that. So that's another, if you will, customer who's being impacted. But I think that those consumers who are more rural and less suburban or urban, they're really thinking twice. Secondly, we're starting to see a bit of a change in trend between grocery and restaurant. And, it's been really interesting. We've talked to a lot of restaurateurs who are in the, let's call it, upper. They said that what they're starting to do right now is really lean into service. And versus like a crisp kind of service, they're focusing more on like warm service. And that, they said, is really having a bigger impact than they expected on repeat visits. And so I would say, if we take a big step back and digest it, if you have to drive farther, if you are, kind of QSR, if you are not really kind of tuned into what's important to the consumer right now, I think that it could be a more challenging summer than when you originally planned for the second and third quarter, depending on how your quarters line up.
I'm also interested, Deborah, what you're seeing and hearing when it comes to food costs and inflationary pressures there. Like when you talk to restaurants, are they saying, hey, we're able to manage that, we're able to offset those costs? Or no, you're hearing, hey, we're taking margin hits?
So I was going to try and get through this whole interview without saying the word AI, but I don't think I'm going to be able to. So what they are saying is that they're really looking at, kind of dynamic pricing, where they're being much more intentional about how they buy food, when they buy food, and thinking about input costs. And then as a result of, right, you can only mitigate so much of these higher costs. And I think they are pretty much across the board higher than what most, I would say, companies had expected. And so they're starting to lean into kind of back of the house operations to see where they can cut costs. This isn't about cutting human capital costs at this point. It's more about, goods not for resale, and, whether it be insurance or, just where can they buy better and improve processes. And so I would say, especially what we're seeing in the restaurant sector, is that they're trying to, it's actually an opportune time for them. They're really trying to do a much better job of taking care of their employees to drive down turnover, which obviously improves kind of not only the quality, but there's a significant cost to turnover. So what's really interesting in this space versus some of the others, I think they're doing a better job of thinking about who the end customer is. I mean, that could be their employee or others. They're focusing more on driving down employee turnover. So they're looking at additional programs. They're also, this is one of the things right with Starbucks, they talked a lot about the employee, where I always thought it was important to put the employee in the center. And then thirdly, food costs are higher than they thought. So they are looking at additional mitigating factors for that. I think it's, right now they're able to handle it, but I do think we heard quite a bit about the next quarter and beyond that, there's only so much that they can adjust in real time.
Deborah, I also want your take on GLP-1 drugs, and I'm just curious what kind of impact you see those new medicines having on restaurants and food companies, and how are restaurants and food companies, Deborah, navigating and responding to that?
So that's a whole other challenging ball of wax. And when you look at the decrease in food consumption as a result, I think, and then also how people are eating differently, right? With the trend towards protein. I mean, there's now even like protein water and whatnot. I think that the restaurants, it's been hard for them to adjust in some cases, either, right, their communication about, the menu items. I think for QSR, it's been easier, but this idea around more protein, smaller portions, helping the customer understand more about what they're eating, right? The consumer is much more interested, this idea around health and wellness. And then I think that going back to these, kind of upper middle, upper income restaurants, they're really focusing on the health and wellness piece, but they also want, right, the consumer to feel like they can treat themselves. When it comes to the CPGs, I don't think that whole sector, I mean, right, we've had mergers, we've had demergers. There's a lot that's happening on all fronts still, let's just say, with, making America healthy again. And I just think there's so much coming at them from the CPG side and the fact that you have own brand, exclusive brands, right? The grocers' own labels growing. The CPG side, I think it's much more complex than it is for the restaurants. I think the restaurants is around messaging and marketing, right? I mean, once again, none of this is easy, and these two sectors are probably the most challenging right now, but I also think there's a significant opportunity to take market share. That's the positive side, and I think those were some of the messages we've seen coming out of.
Coming up, is Berkshire Hathaway still a must-own stock? We're digging into Greg Abel's first shareholder meeting next. Greg Abel, Berkshire Hathaway CEO, held his first shareholder meeting, the first one he led, in Omaha, Nebraska, since taking over from Chairman Warren Buffett. And since Abel took over in January, shares of Berkshire Hathaway have lagged the S&P 500, falling while the market surged to new highs. Cathy Seifert, CFRA Research VP of Equity Research, is joining me now. Of course, you've covered and tracked Berkshire for a long time, Cathy. And so I want to start with, and I know you have a hold equivalent rating here. What would be the argument to own this stock right now? Do you think there is still an argument for someone who doesn't hold Berkshire to buy it today?
That's a good question. And at this juncture, I still have a hold on the shares. First quarter earnings were about in line. Well, they actually were a little better than I was expecting, but there are a couple of things sort of below the surface that I think could potentially be problematic. But, first quarter results, revenues were up 4%. I was looking for 3 to 7%. Earnings on an operating basis, I was looking for 510. They came in at 526. There was a currency boost there. So, on the surface, things look okay. One of the things I noticed that I think is worth keeping an eye on is the deterioration in underwriting results at Geico. It's a significant business for Berkshire Hathaway, and the results that Geico posted this quarter were significantly worse than a lot of its peers. And I think, in the insurance business, trends tend to not turn around on a dime. So I'm concerned that results at Geico are deteriorating. And we didn't really hear a lot of detail about that either.
So we don't know why that's happening necessarily.
Well, because claim accident frequency and severity rose. And the thing is, those results differed pretty significantly from Geico's closest competitors, Allstate and Progressive. And, last year I would note that it was a year of record underwriting profits for particularly the personal lines auto insurance industry, which is why there's now price competition because they had such a profitable year. And Geico seems to be sort of going against that trend and not in a good way. So I think it's something that bears watching.
And what did you think of Greg Abel's performance there? I mean, obviously a lot of people have held Berkshire Hathaway for so long because of Warren Buffett and because of Charlie Munger too, of course. Does Greg Abel give them enough of a reason sort of just from a personality and a leadership perspective to look at Berkshire?
I mean, candidly, I thought the performance at the annual meeting was okay. I mean, he's not Warren, and I think some of the weakness in Berkshire stock was the so-called Buffett premium being extracted from the shares over the last year. Greg obviously has big shoes to fill, and he's a very capable business leader. I think Berkshire Hathaway in general needs to do a better job telling its story. There were a number of questions that I think were left unanswered, not the least of which is one of Warren Buffett's strengths was capital allocation and his investment, and his investment prowess he brought to the table. And with his role decreasing, and at some point he won't be here, I think Berkshire needs to do a better job articulating to investors what the plan is to manage the investment portfolios that they continue to have. I mean, granted, they have, 5 significant holdings that constitute a big swath of the portfolio, but during the quarter, they sold a lot of holdings. There was a lot of back and forth, and I don't think they necessarily gave investors enough information to increase their confidence about that function. I think the other thing is Berkshire Hathaway's capital allocation plan also includes share buybacks. They didn't buy back any shares in 2025. And earlier this year, they announced they were going into the market to buy back shares and only bought $235 million. Now, this is against a cash hoard of about $380 billion. So I think investors are disappointed in the activity of share repurchases or lack thereof. And, I think it just begs the question, if Berkshire isn't buying back their stock, why should you?
Yeah, I definitely think that that's a valid question and one that that investors are asking here. And, to sort of go back to the future of this company, Cathy, I mean, and something that Greg Abel said is that, he doesn't think that Berkshire would be better served by breaking it up, right? By sort of separating it into its component parts. But I have to think that if you look out 5-10 years from now, that Berkshire could look very different or might not even exist in this, despite him saying that. I mean, what do you think that kind of future picture looks like for Berkshire?
I mean, my sense was that Greg might be a little more buttoned up in terms of the operations and the sort of the structure of this kind of far-flung empire, if you will. Berkshire has a lot of subsidiaries. I think an argument could be made to consolidate some of the small subsidiaries and kind of get some economies of scale. I mean, that's something that historically Berkshire Hathaway has not done. I was getting a sense that Greg may be leaning in that direction, but I do think that unequivocally Berkshire has no plans of breaking up and they will maintain their conglomerate structure. To answer your question about what they look like in 5 years, I think that's going to depend on the degree to which they grow organically or they grow through acquisitions. Having said that, my sense is Greg's comfort zone is in sort of the energy and industrial space. And you could see that during the meeting when he was talking about Berkshire Hathaway Energy, when he was talking about BNSF, he felt very comfortable. When the conversation sort of got over to either long-term strategy or acquisitions or capital allocation, you just didn't get the same degree of confidence in his voice. So, my sense is in terms of the mix of businesses at Berkshire, given Greg's background, it looks like if anything, they may go deeper in the industrial and energy space. Mm-hmm. But I mean, they're not giving any indication. So, honestly, it's just speculation at this point.
We have to guess until they tell us, Cathy, but it's going to be very interesting to watch to see what happens. Thank you so much. Really appreciate it. And
Take
that is,
care.
thank you. That is it for Market Catalyst. I'm Julie Hyman. Thank you for watching. More Yahoo Finance coming up.